Namaste and a very warm welcome to the 10th episode of FinWell Daily Brief for Friday, March 28th, 2025, recorded at 15:30 hours Indian Standard Time. Today, we're going to try to decode all those financial figures and some key economic news coming out of India, especially looking at what these developments really mean for your financial health. So let's kick things off with an interesting insight from the Reserve Bank of India, or RBI.
Okay.
Now get this, more than 55% of how Indian households save their money, it goes straight into bank deposits, right? Think about that 55% bank deposits.
Wow.
Compare that to just about 10% in equities and mutual funds. What does that tell you?
It's a clear indication of where the priorities lie.
Yeah.
Right? I mean, when it comes to financial security for so many of us.
Exactly.
This preference for bank deposits really reflects certain level of risk aversion,
right,
that we see among many Indian households. They're looking for that stability, that security.
Sense of safety.
Exactly. That's right.
Now, with that picture in mind, let's shift gears a little bit and see how the market's wrapped up today.
Yeah, let's dive into the market summary.
Yeah.
For March 28th, Friday, at 15:30 hours Indian Standard Time. And, we did observe a general downward trend across the major indices.
Okay.
The Nifty 50, it closed at 22,500.70. which is a dip of 91.25 points, or about 0.39%.
Okay.
The Nifty Midcap 150 ended at 19,084.90 CR, down by 81.4 drive-in, or 0.42%. The Nifty Small Cap 250 finished at 15,081.95, a drop of 29.70 points, representing a 0.20% fall.
Okay.
And lastly, the Nifty Total Market Index settled 11,970.1 EAR, declining by 56.05 points, or 0.47%.
So overall, a bit of a subdued day in the equity markets.
Absolutely.
Now let's switch our attention to the bond market for a moment.
Sure.
We saw a little bit of a move in the 10-year government bond yield.
Yes, we did.
What's the story there?
So the 10-year government bond yield decreased to 6.60%. Down from 6.70% yesterday.
Okay.
Now, this slight dip, it could suggest a couple of things. Maybe there's an increased demand for these government bonds, as investors sort of anticipate potential shifts in monetary policy down the line. Or, could even be a move towards safer havens.
Right.
Amidst those light uncertainties we're observing in the equity space.
That makes sense.
So this raises an interesting question. How might these subtle shifts in the bond market influence your investment strategy?
Yeah.
Particularly in fixed income.
That's a really good point to think about.
Yeah.
And, moving over to the currency markets, it looks like the Indian Rupee had a pretty good day against the U.S. dollar.
Yeah, it did. The Indian Rupee appreciated to 85.5875 per U.S. dollar, strengthening from yesterday's rate of 85.77.
Okay, so this isn't just like a one-off thing. This is part of a larger trend. We've been seeing this throughout the month.
Exactly.
So let's dig into some of the, top financial and economic news that's been making the rounds.
Yeah.
One that really caught my eye was the government's plan for bond sales. We're talking a sizable 8 trillion rupees.
Yeah, that's a significant number.
Yeah. So break this down for us. What's the thinking behind this massive borrowing program?
So the Indian government is planning to raise a substantial 8 trillion rupees through bond sales between April and September. Now, to put this into perspective, this represents 54% of their total estimated borrowing for the entire upcoming fiscal year.
Okay.
The primary goal here is to manage the fiscal deficit, which they're aiming to keep at 4.4% of GDP for 2025-26.
Okay.
Now, this level of borrowing, it can have a few implications.
Yeah.
Sometimes increased government borrowing can lead to what economists call crowding out, where the government's demand for funds increases competition and potentially pushes up interest rates.
Okay.
So, that could affect borrowing costs for businesses and individuals.
Right. It's all interconnected, isn't it?
It is.
And on the topic of positive movements, the Indian Rupee's recent strength has been quite impressive.
It's been remarkable.
On track for its best monthly performance in over 6 years.
It is.
So what's driving this remarkable appreciation?
So the Indian Rupee is indeed enjoying its best monthly performance in over 6 years, having appreciated by more than 2% against the U.S. dollar since the beginning of March.
Wow.
One of the main factors behind this strengthening is the renewed interest we're seeing from foreign investors in Indian equities.
Oh, that makes sense.
So when foreign investors are optimistic about India's growth, they invest in Indian companies.
Yeah.
And to do that, they need to buy rupees.
Right.
Increasing demand for the currency.
And that pushes the value up.
Exactly.
And we've seen those foreign equity inflows, haven't we?
We have.
I believe the figures were exceeding $6 billion
Yes.
in just the last 6 trading days.
That's right.
That's a huge influx of capital.
It is a significant inflow, and it represents a reversal of previous outflows.
Yeah.
And this inflow of foreign capital, it provides a lot of support to the rupee,
Okay.
strengthening its position against the U.S. dollar. And it reflects growing confidence among international investors in the Indian market.
But when we look at the bigger global picture, there are potential challenges on the horizon, right?
Girl.
The anticipated U.S. tariffs on automobile imports, that could introduce some uncertainty,
Absolutely.
particularly for export-oriented economies like India.
That's a valid concern.
Yeah.
We do need to remain vigilant about potential developments globally. The expected announcement of new tariffs by the U.S. on automobile imports is a factor that could introduce some caution into the market.
Yeah.
If we look at India's export sector, especially the automobile industry, such tariffs could impact their competitiveness. In a major market like the United States,
Right.
it's a reminder that domestic financial health is also influenced by global trade dynamics.
Yeah, absolutely.
What are your thoughts on today's equity market performance?
Well, that modest 0.39% decline in the Nifty 50, do you think that could be partly attributed to this apprehension surrounding the government's borrowing plans and these potential international trade concerns?
It's certainly possible. The Nifty 50's slight dip could reflect some cautiousness among investors. The government's substantial borrowing, it's raising questions about its potential impact on interest rates and economic growth. And simultaneously, the uncertainty around those U.S. trade policies, particularly the ones on auto imports, could be weighing on investor sentiment.
Yeah, that makes sense.
Market movements are often a result of these interconnected factors.
They are. It's a complex interplay.
It is.
Now, what about those declines we saw in the mid-cap and small-cap segments?
Right.
Does that suggest a broader risk-off mood?
I think it does suggest a general sense of caution in the market. But the slightly smaller percentage drop in the small-cap index compared to the mid-cap, that might indicate that there are still certain areas or individual stocks within that small-cap space that are attracting investor interest.
Interesting.
Perhaps due to their strong fundamentals.
Yeah.
Or growth prospects.
Okay, so even within a broader market downturn, there can be these pockets of opportunity. Okay, now let's go back to the currency and bond markets for a second.
Okay.
The rupee's appreciation, it's more than just a number.
It is.
It has wider implications, doesn't it?
It does.
What does a stronger rupee mean for the Indian economy and for us?
So a stronger rupee, it makes imports cheaper, which can help in controlling inflation.
Okay.
It also enhances the returns for foreign investors holding Indian assets. But it's important to remember that a very strong rupee can make Indian exports more expensive for international buyers, which can impact our export competitiveness.
Right, it's a balancing act.
It is.
And those movements in the bond yields, that small decrease seems quite significant now.
It does.
When we look at the overall picture.
Right.
So what are your thoughts on that?
That slight dip in the 10-year government bond yield indicates increased demand for these bonds, as we discussed earlier.
Yeah.
This could be driven by, expectations of monetary policy easing, or just a move towards safer assets amidst uncertainty. In the equity markets, for investors understanding these yield movements, it's crucial, as they directly impact returns on fixed income investments.
Right.
It can be an indicator of broader market sentiment regarding risk and future economic conditions.
So let's zoom in on specific sectors now.
Sure.
The automobile industry. They're facing those potential U.S. tariffs. What are some immediate concerns and adjustments that Indian manufacturers might be looking at?
I think the potential tariffs on automobile imports are definitely creating some uncertainty. For Indian auto manufacturers that export to the United States, the immediate concerns would likely be around potential cost increases for exporting, which could affect their pricing and competitiveness.
Yeah.
We might see manufacturers reassessing their supply chains, exploring alternative markets, or even adjusting their production strategies to try and mitigate the impact of these potential tariffs.
Right. So keeping a close eye on those policy announcements and company responses is going to be key. Now, what about the banking and financial services sector? How might the government's borrowing plans and fiscal deficit targets impact this crucial part of the economy?
So the government's borrowing program and those fiscal deficit targets, they're very likely to have a noticeable effect on the banking and financial services sector. Increased government borrowing can sometimes put upward pressure on interest rates,
Mm-hmm.
which can affect the cost of funds for banks.
Okay.
Additionally, it can also influence the availability of credit in the economy.
Right.
So banks and financial institutions will be closely monitoring these developments. As they make decisions about lending rates and their financial planning,
Okay.
the government's fiscal health and borrowing strategy are definitely important
Yeah.
for the stability and growth of the financial sector.
Absolutely. So looking ahead, with all these factors in play,
Yeah.
the market movements, the government borrowing, the currency fluctuations, the global trade dynamics, what are some of the key investment themes that you think investors should pay attention to?
I think from an investment perspective, there are several themes that stand out. Firstly, the government's planned 8 trillion rupees borrowing in the first half of this fiscal year.
Yeah.
That will definitely continue to shape the bond markets and influence the interest rate environment. Understanding how this might affect your fixed income portfolio and the potential trajectory of interest rates is crucial.
Absolutely.
Secondly, the evolving global trade landscape, particularly those U.S. tariff policies, requires careful monitoring,
Yeah.
especially if you have investments in companies, with significant export exposure.
Right.
And finally, that recent surge in foreign portfolio investment has been a significant positive factor
It has.
for both the rupee and equity markets. So keeping an eye on the sustainability of these flows and any potential shifts in foreign investor sentiment will be key to navigating market volatility.
Yeah, absolutely.
It's a dynamic environment where domestic policies and global uncertainties are interconnected,
They are.
shaping those market sentiments and opportunities.
Yeah. All right, so let's recap the key takeaways from today's FinWell Daily Brief.
Sure.
We saw a slight decline in the equity markets. We saw a strengthening rupee driven by robust foreign investment. And we've got those significant government borrowing plans on the horizon.
We do.
And of course, we highlighted those potential impacts from global trade developments,
We did.
especially those anticipated U.S. tariffs.
Yeah, it's a lot to keep track of.
It is, but it's important information.
Absolutely.
So if you want to stay ahead of the curve with all these financial insights, make sure you subscribe to FinWell Daily Brief. It's your daily dose of what's happening in the markets. Now for more in-depth discussions. And to connect with our team, you can reach out to SOS FinWell on LinkedIn. We'd love to hear from you. And, as we wrap up, I want to leave you with a thought. We talked about the Reserve Bank of India's findings on household savings.
We did.
That preference for bank deposits over equities. So how might these market dynamics we discussed today and financial literacy initiatives, how might they reshape these investment preferences in the years to come?
That's a great question to ponder.
It is. It's something to think about.
It is.
And for more analysis and discussions, make sure you subscribe to FinWell Daily Brief and connect with SOS FinWell on LinkedIn. And to close out today's episode, I want to leave you with the quote from a legendary investor, Sir John Templeton. He wisely said, "The 4 most dangerous words in investing are 'this time it's different.'" So thank you for tuning in to FinWell Daily Brief. We'll see you next time.